Welcome to the deep dive. We're here to help you cut through the noise and really get to the core of your essential learning materials. And this deep dive, it's tailored specifically for you, especially if you're tackling accounting for managers thinking, University of Colombo's MBA 5101 type curriculum.
Absolutely. Our goal today is more than just summarizing. It's really about connecting the dots. We're going to jump from those fundamental mechanics of accounting, the things you absolutely have to nail down, right into the cutting edge of how companies report now, integrated reporting. And we're using your lecture material as our guide, really focusing on the strategic takeaways a manager needs today.
Okay, sounds good. So let's start right at the very beginning. Why do we even need this whole system of financial accounting? What's the fundamental reason?
It really boils down to one core concept in business: the separation of ownership.
Separation of ownership. Okay.
Yeah. Think about it. Once the shareholders aren't the same people running the day-to-day business, the management, you suddenly need a formal way to report back. It needs to be unbiased, verifiable, standardized. So management can show how they've looked after the owner's interests. That's really the birthplace of professional accounting.
Got it. And when we talk about what accounting is, the source material gives us that pretty solid definition from the AICPA, the American Institute of Certified Public Accountants.
Yes, and that definition is key because it sets the stage perfectly. It calls accounting the art of recording, classifying, and summarizing in a significant manner, and in terms of money transactions and events which are, in part at least, of a financial character. And here's the crucial part, and interpreting the results thereof.
Interpreting the result. That sounds like where the real value add comes in.
Exactly. It's not just about following rules. The ultimate aim is understanding what the numbers mean.
Right. And that interpretation piece, that's where the manager really steps up. But before we get there, we have to understand the engine room, right? The routine functions that make it all happen.
Absolutely. You need those flawless functions first. So, number one, recording. This is done using the bedrock, really, the double entry system.
The classic debits and credits.
Precisely. It's ancient, but it's brilliant because it has that built-in check. Every transaction has two sides, so it always balances. It's a fundamental check on accuracy.
Okay, recording first. Then what?
Then you take that recorded data and you move to classifying. This happens through ledger posting. You're basically sorting all those recorded journal entries into specific accounts: cash, sales, expenses, you name it.
Sorting it all out.
And the third step,
Summarizing. All that classified information gets pulled together in the trial balance.
the trial balance. Okay, and this is a critical document. It proves the mathematical equality of your debits and credits, and importantly, it's the direct source for two of the main financial statements: the income statement, or IS, and the statement of financial position, the SFP.
Now, it's really important to remember here, as the material points out, that these two statements, the IS and SFP, they're based on the accrual basis of accounting.
Yes, that's a crucial distinction. Accrual accounting aims to match revenues with the expenses incurred to generate them, regardless of when cash actually changes hands.
So it gives a good picture of profitability over a period, but maybe not the cash situation.
Exactly. It's great for measuring performance and matching effort with reward, you could say, but its weakness, its deficiency, is that it doesn't track actual cash flow. You could look profitable on paper, but have no cash in the bank.
So why stick with accrual if it has that blind spot?
Because fundamentally, it provides a better measure of performance over time than just tracking cash. So we stick with accrual for the IS and SFP, but we address that deficiency with another key statement.
The cash flow statement.
Precisely. The cash flow statement, prepared on the cash basis, provides that necessary lens on liquidity. It shows where the cash actually came from and where it went. It complements the accrual statements.
Okay, so we have recording, classifying, summarizing, leading to these accrual-based statements, plus the cash flow statement. Now, where does the manager really fit in beyond making sure these processes run smoothly?
This is where we loop back to that AICPA definition. The routine functions are essential. They have to be perfect. But the true managerial function is that final step: analyzing and interpreting those statements.
Okay.
It's about taking that data and turning it into information that supports managerial decision-making. It's a fundamental shift from just, ticking boxes and complying to actively using the information for strategy.
So it's less about being a scorekeeper and more about being a strategist using the scores.
You've got it. And importantly, managers don't just rely on financial accounting data anymore. They need a broader view. They're pulling information from Financial accounting, yes, but also specific internal data from management accounting. Things like cost analysis, budgeting, forecasting.
Stuff that's more forward-looking.
Exactly. And increasingly, they also need to factor in other external information market trends, competitor actions, economic indicators. You need all three pieces, financial, management, and external, to make smart decisions, whether they're short-term operational ones or long-term strategic moves.
Right. That makes sense. You need the full picture.
Right.
Okay, so now that we understand the basic process and the manager's role in interpreting it, let's talk about the rules. What actually goes into something like an annual report? You mentioned it's complex.
Oh, it is. It's definitely not just one rule book. Think of it more like an ecosystem of standards and principles. First off, you have your core financial reporting standards. In the context of your Sri Lankan materials, that means the Sri Lanka Accounting Standards SLFRS, which align with IFRS, and LKA issued by the Institute of Chartered Accountants of Sri Lanka, CA Sri Lanka. These dictate how you measure and present the financial numbers themselves.
The nuts and bolts of the accounting.
Pretty much.
Yeah.
But that's just layer one. Then you've got a significant layer of local, legal, and regulatory requirements that shape the report.
Like company law.
Exactly. The source material specifically mentions things like the company's Act Number 7 of 2007, the listing rules if you're on the Colombo Stock Exchange, and various codes of best practice on corporate governance. These cover how the company must be run, how it manages risk, how it governs itself. It's the mandatory legal framework.
So financial rules, legal rules.
Yeah.
What else? Because modern reports seem to talk about much more than just profits and compliance.
That's the big shift. That legal structure is just the baseline now. The mandate has really expanded to include sustainability and this idea of integrated thinking. This is where local rules meet global expectations.
Okay, so how does something like climate change or social impact find its way into a formal report? What drives that?
That's where you see the influence of broader frameworks, particularly the International IR framework. That's the Integrated Reporting Framework from the IRC, the International Integrated Reporting Council. And this framework often pulls in or works alongside other major global sustainability standards. Think of things like the GRI standards, Global Reporting Initiative, the UN Sustainable Development Goals, the SDGs,
Okay.
the principles of the UN Global Compact. Companies are increasingly expected, sometimes required, to report on their environmental, social, and governance ESG performance using these kinds of standards. The IR framework helps structure that.
Right. So it's really layering up financial standards, local laws, governance codes, and now these global sustainability and integrated reporting frameworks.
Precisely. It's a multi-layered compliance and communication challenge.
This brings us squarely to integrated reporting, or IR. You said this is where it gets really interesting. Why? What's the big idea?
Well, the IIRC, the council behind it, is quite a force. It's this big global coalition. You've got regulators, investors, companies themselves, standard setters, academics, NGOs,
Huh?
a real mix.
Okay.
And they all share this view that the next logical step, the evolution in corporate reporting, is about communicating value creation, or just as importantly, value preservation, or even value erosion. It's a much broader concept than just profit.
So it's not just about the financial bottom line anymore.
Not at all. Their long-term vision is pretty ambitious. It's not just about creating a different report. It's about embedding integrated thinking into how businesses actually operate day to day.
Integrated thinking, meaning?
Meaning businesses consciously consider the connections between their strategy, their governance, their performance, and their social and environmental context. They want integrated reporting to become the norm globally.
Why? What's the hoped-for outcome?
The belief is that this cycle better, more holistic thinking, leading to better reporting, which then informs investors and stakeholders, will ultimately lead to more efficient and sustainable allocation of capital. Better decisions, basically.
Okay, so what are the specific aims of the IRC according to the material?
They list three key aims. The first is probably the most traditional. Improve the quality of information available to providers of financial capital investors, lenders, so they can make better allocation decisions.
Makes sense. Better info, better investment.
Second, promote a more cohesive and efficient approach to corporate reporting overall, trying to connect the dots between all those different reports companies might produce.
Okay, streamlining things.
But the third aim, this is the game changer, it's to enhance accountability and stewardship for a broad base of capitals,
Yeah.
plural, and promote understanding of their interdependencies.
A broad base of capitals, not just financial capital.
Exactly. This is the conceptual leap of integrated reporting. It holds organizations accountable for how they use and affect multiple types of capital.
And this is where the famous six capitals come in, right? This is the aha moment.
That's it. The framework explicitly identifies 6 categories of capital that organizations rely on and impact.
Hmm.
Let's list them out clearly. There's financial, obviously. Then manufactured buildings, equipment, intellectual patents, know-how, systems, human skills, competencies, motivation, social and relationship networks, brand reputation, stakeholder trust, and finally, natural capital, air, water, land, biodiversity.
Wow, okay. Financial, manufactured, intellectual, human, social and relationship, and natural. That's a lot more to manage and report on than just money.
It absolutely is. And it forces a fundamental rethink. How does a company actually measure its impact on, say, social and relationship capital or natural capital? It's challenging.
Yeah, I can see that. Measuring financial capital is straightforward, relatively speaking. Manufactured too. But intellectual, human. How do you put a number on organizational knowledge or employee morale in a reliable way?
That's precisely the challenge and why the framework is so demanding. It pushes companies to develop ways to track and articulate how they are maintaining or depleting these other capitals. It's not always about precise monetary values, but about demonstrating stewardship and impact.
So, if it's that complex, how does the IR framework guide companies on actually preparing these reports? Are there specific rules or principles?
Yes, there are guiding principles for preparing and presenting the report. These act like filters for the information. They ensure the report achieves its purpose.
Okay, let's quickly run through those. What's the first one?
Strategic focus and future orientation. The report can't just be a rearview mirror. It has to explain the strategy and how it's expected to create value using those 6 capitals over the short, medium, and long term.
Right, looking ahead. Makes sense. Second, connectivity of information. This is crucial for that integrated thinking idea. The report must show the links and relationships between different pieces of information. How does governance affect risk? How does strategy impact resource allocation across the capitals? It needs to be a holistic story, not isolated silos.
Connecting the dots internally. Got it.
Third, stakeholder relationships. The report needs to explain how the organization relates to its key stakeholders and how it understands and responds to their needs and interests, because those relationships are a form of capital, social, and relationship capital.
Okay, what else?
Fourth is materiality. This is a big one. The report should only include information that could substantively affect the organization's ability to create value over time. It's about cutting through the clutter and focusing on what truly matters. It forces judgment.
So focus on the important stuff. Avoid drowning in data. Exactly. And then the last 3 are more about the quality and presentation. Conciseness, keep it as brief as possible without losing meaning. Reliability and completeness of the information must be accurate, balanced, including bad news, not just good news, and free from material error.
And the last one?
Consistency and comparability. The report should be presented consistently over time so you can track progress and in a way that allows comparison with other organizations as much as possible.
Okay, those principles provide the how. What about the what? Does the framework specify the actual content sections that must be in an integrated report?
Yes, it does. There's a required content architecture. It starts with the big picture. Organizational overview and external environment, what the company does, where it operates, and importantly, the external factors influencing it, economic conditions, political climate, legal changes, market trends.
Setting the scene.
Then governance.
Hmm.
How is the organization structured? How does that leadership structure support its ability to create value and think in an integrated way?
Right. Structure and context first.
Then you get to the heart of it, the business model. This is really central. It explains how the organization takes mission. Inputs drawing on those 6 capitals, uses its business activities to transform them, creates outputs, products or services, and ultimately achieves outcomes, which are the positive or negative impacts on the 6 capitals.
Ah, that input activity output outcome flow. I think the material mentioned JKH as an example there.
Yes, models like that illustrate how a company visualizes this value creation process across the capitals as the engine room of the report.
Okay, after the business model.
Risks and opportunities. What are the key uncertainties and potential upsides the organization faces related to its value creation? And importantly, how are they being managed or mitigated?
Makes sense. Connects back to strategy.
Which is the next section. Strategy and resource allocation. Where does the organization want to go? How does it plan to allocate its resources across all 6 capitals to achieve its strategic objectives?
Strategy links goals to resources.
Okay. Then comes performance. How did the organization actually do against its strategic objectives? This includes quantitative financial results, yes, but also performance related to the other capitals. Things like an economic value added statement or a review of how each capital was managed might appear here,
Looking back at results across the board.
followed by the outlook. Looking forward again, what challenges, uncertainties, and future opportunities does the organization anticipate? How might macroeconomics or political volatility affect it?
So context, governance, business model, risks, strategy, performance, outlook, anything else.
One final crucial piece,
Yeah.
the basis of preparation and presentation. This is the transparency section. It needs to explain how the report was put together, what standards were used.
Mm.
Critically, how did the organization determine what was material? What's the scope or boundary of the report?
Okay, so that basis section kind of underpins the credibility of the whole thing.
Absolutely. It shows the reader the methodology behind the report.
Wow. Okay, so stepping back, we've gone from a simple definition of accounting as recording, classifying, summarizing,
And interpreting.
right, and interpreting financial events, all the way to this really complex, holistic framework of integrated reporting, demanding integrated thinking across 6 different capitals, governed by principles and specific content requirements.
It's a huge conceptual journey, and it means the role of the manager, especially someone studying accounting for managers, has fundamentally shifted. You're no longer just a guardian of financial data.
You have to be an interpreter of this much broader set of information, right? Balancing the numbers with governance, with sustainability, with strategy.
Exactly. You need to understand how financial results connect to, say, human capital development or natural capital impacts. You need to navigate these complex reporting requirements, like SLOF, RSLKS for the financials, and frameworks like the IRCs for the broader picture. It demands integrated thinking.
Okay, so to wrap up this deep dive, let's leave our listeners with something to think about, building on that complexity. We talked about how hard it is to measure some of those non-financial capitals.
The intangible ones especially.
Right. So here's a thought. If you were tasked with evaluating a brand new startup using this integrated reporting framework, forget the financials for a second. Which of the other 5 capitals, manufactured, intellectual, human, social relationship, or natural, do you think would be the absolute hardest for that startup to measure or even articulate reliably?
Ooh, that's a tough one for a startup.
And thinking about that difficulty, why might that specific ambiguity, that lack of clear measurement for that particular capital, fundamentally complicate how an early-stage investor, like a venture capitalist, decides whether or not to put their money in?
That's a great question to ponder. Which capital is most opaque at the start, and what does that opacity mean for investment?
Something to definitely mull over as you continue your studies in accounting for managers.